If you're an active real estate investor and you're looking to do larger deals, you're in the right place. We are going to go and take the conceptual type of stuff that you listen to from other real estate podcasts and bring it down to the tactical, the nitty-gritty, the actual actionable types of things that other real estate investors that went big did to grow their own real estate empire. You're listening to the Go Big Live podcast. I'm your host, Matt Druin. Welcome to the Go Big Live Real Estate Investors podcast. I am your host, Matt Druin. I am super excited today. I have a very special guest named Brian Burke. If I can give you a little bit of an intro to Brian, he is president of and CEO of Praxis Capital, a vertically integrated real estate private equity firm, and author of The Hands-Off Investor, an insider's guide to investing in passive real estate syndications, published by Bigger Pockets Publishing. You know, we got a titan here, right? And Brian's focus is primarily on 150 plus unit apartment complexes, but over the last 30 years, he has done over 500 single family flips, owned over 100 single family rentals, done residential and commercial development, self-storage, hospitality, vacant land, and commercial deals. He has purchased over $800 million of real estate, including over 4,000 apartment units, and raised over $200 million from investors. So thank you so much for coming on the show, Brian. I appreciate it. And yeah, thank you so much for coming.
Well, it's my pleasure to be here, Matt. I think this is going to be a lot of fun.
Yeah, absolutely. So first question we always ask our guests is, you were born and now you're here. What happened in between?
No, not much. Yeah, it's funny you asked that question because I oftentimes hear people say to me like, oh, hey, I want to be investing in 100-unit apartment buildings, but I've never done a real estate deal before. And it's like, nobody is born as a full-grown adult. You kind of have to go through a lot of phases before you get, to be walking around and driving a car and holding down a job and that sort of stuff. Real estate, kind of the same thing. I started out working, I wouldn't say a 9 to 5. It was like, it was a 4 to 1, like 4 p.m. to 1 a.m. kind of stuff. So I was in law enforcement, and I was doing that to pay the bills while I was trying to build a real estate business. And 14 years later, I had built enough of a real estate business I could hang up the W-2 job, go out on my own, and try to strike it big in real estate. And somehow or another that managed to work out.
So let's back up a little bit. So tell me about, it sounds like you got some background in single family home flips. Can you tell me about like the seminal moment of when you did your first big deal, or what was big to you at the time?
Well, everything I did was big to me. When I bought my first real estate, my first house, it was just this little, like, I don't even know. It wasn't even a $150,000 house. It might not even been a $100,000 house, but to me that was huge because I was 20 years old. It was the biggest thing I'd ever bought. It was amazing that I could even pull it off because I did it with no money down. I found a finance company that would finance, like, I don't know, 80 or 85% of it or whatever it was. And I convinced the seller to carry back the balance of the down payment. So I literally bought that house with nothing. And to me, that was huge. And then the next deal I did was like a $200 and something thousand single family house flip. And to me, that was absolutely huge. So it's funny, like throughout my entire career, everything I've done was big. The last real estate deal I did was a $150 million purchase. And that was big. So I'm still amazed sometimes at how going big can continue to get bigger.
Yeah, 100%. I mean, it's like I tell a lot of people that are in our real estate investors association and in my and among my students, it's like I'm always pushing the envelope. Everything that I'm dealing with, like, there's something new about it. And I think that, there's a mantra of like, if you're not growing, you're dying. And I think that, it's essential for you to like keep that fire alive in yourself and exposing yourself to new things. And, it really brought it to light, being a new father a couple of years ago and seeing the world through a child's eyes, and it kind of like, had this, spooky sort of like flip on is like, all right, this is the reason why I want to keep pushing the envelope and keep doing things that are kind of outside that envelope. So if you can think of maybe that first deal that maybe was like, maybe, you know, had some hair on it, or it was like seemingly unsurmountable to you, maybe like on the commercial side of things, that's fresh in your memories, where you could, maybe the first time you had to raise capital for a deal, maybe a good one. Do you got something in mind?
Well, I could probably do one even better than that. Is my first multifamily acquisition was a 16 unit apartment building here in California. And it was the biggest real estate deal I'd ever done, even though at the time, this was like 22 years ago. It was only, I don't even remember how much it was, like $500,000 or $600,000, I mean, now you can't even get a single family out here for that. But this is a 16 unit apartment building. And that was just a massive deal for me at the time. And I was able to pull it off I was doing a lot of house flips. And eventually I got to this point where I thought, every once in a while, when I buy a house to flip it, I want to keep one. And I had kept a couple of these houses. They went up in value over a couple of years' time. And I decided that, it's time to get into going big and go get into commercial multifamily. And I didn't know anything about it really. But I did a 1031 exchange. I sold the two houses. I took the money that I had from those two houses and rolled it up into this 16 unit apartment building. And it wasn't enough. I could get a loan from the bank, but I think I only had like maybe 10% down, and I needed 25. So I went back to, a page from the first deal playbook and convinced the seller to carry back a down payment for 15% of the purchase price, and got into that deal with no money out of my pocket, even though I did take some money that I rolled from previous real estate deals that I bought with no money out of my own pocket. And then that was my first kind of like, commercial multifamily purchase. And, it had a lot of hair on it. Believe me. I mean, it was in all kind of states of chaos. And it took me a couple of years to get it stabilized, I had to fire the property manager, and, then get a different property manager, and then fire the different property manager, and then decide to manage it on my own and hire an employee to, be on site. And then that didn't work out, and then hire another one, then find out he's on drugs, and then hire another one. And go through all those trials and tribulations of a real estate investor. And I always like to say, like, if you can survive those kinds of like the small deals that have all these issues and all this grief, if you can survive that, then you'll be ready to, go even bigger.
Yeah, 100%. So let's back up a little bit on that 1031 exchange. I mean, did you have that 16 unit property identified before you sold those two houses, or did you sell those two houses? The funds went into the qualified intermediaries account, and you had that 1031 gun against your head. Like, can you tell me about that?
Yeah, it was, I think, just really, really lucky. Is I knew what I wanted to do. And so I went and talked to the agent that was selling all of my house flips, was a CCIM. So I went to his office. And I'm like, Al, I don't know anything about, this commercial multifamily stuff. I don't know. I don't understand the numbers. And he's like, I'll show you how this works. So he walks me through the whole thing about the income statements and rent rolls and all that stuff. And I thought it was just great. I mean, I learned so much in like an hour and a half time, right? It was opened up a whole new world to me. And then I had put those two properties on the market, and I think they were either in marketing or maybe he had just gone into escrow, when he called me and was like, hey, I'm about to sign a listing agreement on this property. We just had this meeting. I know you're looking for something like this. Would you like to make an offer on it before it goes out to market? And of course I was like, yeah. So it all just kind of worked out that I got that into contract right around the same time the two properties were going into contract, and timing wise, it just kind of all fell right into place. That was a time when, the market was not like on fire. When the market's really on fire, it's so difficult to time those 1031s. The market was in a balanced state, and I had took a little bit of time to sell the outgoing properties, and and the incoming property was kind of a little harder for them to find buyers. So it just kind of all fell into place.
Okay, sweet. So that's kind of like where, you got the seller carry back. You had the 1031 proceeds as, the other part of your down payment. How did you find the financing, the permanent financing for the acquisition of the property?
I got a bank to do it. There was a local bank in that city that did a lot of commercial lending. So I approached them and said, I'm buying this apartment building, would you guys do the loan on it? And went through their whole application process, appraisal, whole 9 yards, just fresh, cold call. I wasn't a customer of the bank already. But they were a local bank in that city, and that's kind of was their bread and butter, was to loan on local commercial property.
Yeah, so it wasn't a relationship that existed before. So was that a relationship that blossomed into something else, or was it like kind of like a one and done type of deal?
It did a little bit. I had them do some loans on a couple of house flips I did, which was nice. I think at one point they had foreclosed on some property, and then I ended up buying the property through the foreclosure. And they had foreclosed on a second, so they still had the first. So they sold it to me basically subject to the existing first, and we did a couple deals after that. But then when I refied that property, ultimately, because I wanted to get the seller out, Usually when you do a seller finance, you'll say, carry back 15% for 3 years, 5 years, whatever. I didn't want to have a gun to my head. So when the property value went up, I wanted to get a permanent loan on it that would encompass both the original first and the second that the seller had. So I had a small relationship with Wells Fargo Bank, and I went to Wells Fargo and they did the whole deal. So it actually worked out pretty good.
Okay, so you refied the whole capital stack. What was that? And so we were able to push that value over that time period. And I do want to go back as to how you pushed that value. But like, was there a prepayment penalty on the first mortgage with the community bank, or what?
There wasn't. That was the beauty of it. Or if there was, it expired. It might have had like a 1% or 2% prepay for the first year or two, but I don't remember now. It's been almost 20 years, but there wasn't any prepay that I had to pay. So it kind of worked out good. When you get into larger multifamily loans, then prepays are extraordinarily common. When you're in that kind of sub $1 million space, there's all sorts of different loan products out there from local banks, or you can get around some of that prepay, or at least have shorter prepays or easier ways to get out of them.
Yeah, absolutely. So Brian, how did you do the what was your, you went through a lot of property managers this property. Kind of what were your mistakes on that? Because I mean, you went through a lot of people. Like, what would you, if you were to, rewind back the clock, what would you have done differently in terms of, executing the plan on that property?
Well, in truth, if I'm being honest, I would have done nothing differently, because there were a lot of things that, had I done it differently, the outcome probably would have been better, but I wouldn't have learned as much. And so I mean, who I am today is a culmination of everything that I've experienced throughout my whole 30-something year career, my whole 50-something time I've been on this planet. And I wouldn't be who I am without the experience that I've had. And if I change any one thing, I would lose a component of that experience, and I might not be where I am right now. And so even though, hey, hiring my own employee manager was probably a mistake. I should have stuck with third-party property management and just got a better one. But I learned a lot about, the hands-on aspect of property management. I also learned a lot about myself, that I'm not a good property manager. It's far better to have good people around me that are better at that than I am. And it's much better to learn that then than it would be to learn it when I have the scale that I have now. So I wouldn't have done a single thing differently, even though there's 100 things I could have done differently that would have produced a better investment return, or a better financial outcome, or push the value higher, or whatever other kind of excuse you can make. But all this is all about it's a learning curve.
Yeah. So what happened between, so you went through this thing, so you're like, and you got your arms finally around this property with the right people in place. Like what happened from there when you went to Wells Fargo?
Yeah, once I had that property refied, it had really good, stable property management on it. That thing just performed, and I kept that thing for, I guess it was about 15 years before I finally sold it. It was weird. I had bought and sold like hundreds of millions of dollars of property, but I always still had this one deal. I never did anything with it. I just let it sit there. And ultimately, I was able to do a 1031 exchange out of that into a vacation rental that ultimately now I get to use. So, and I get to rent it out. So it was a springboard into creating a base of wealth, but also an enhancement to my lifestyle, because now I get to go relax in Maui whenever I want because of that apartment building, which I would not have been able to do had I not done that deal.
Okay, awesome. Now, did you refinance that property again after that Wells Fargo debt was on it, or what happened, or just keep it on
No,
there?
that was it. I never touched it again after that. Yeah, I did that one refi and then just let it ride.
Okay. Yeah. So, us as a company, I mean, we typically will refi and rebalance like every 5 to 7 years. And so, because our tax efficiency starts to drop at our properties, and we haven't done things like cost segregation analysis yet. So that's kind of what we do. So I mean, when people is talking to us about, well, aren't you scared that your debt's only fixed for 10 years? I was like, that's awesome, because we're not going to be holding it for over 10, that debt on there for over 10 years. So, and if interest rates creep up too high, then we don't refinance, we don't refinance it. We keep the same debt on it. So I know that's definitely good to know. So what's your refinancing sort of temperament now as an active investor?
Well, I haven't really had much chance. I've refied a couple of properties, just mostly to return capital to investors and boost their investment returns. But more recently, like over the last 5 years, we've never had a chance to refi. The values have gone up so quickly that we've just been selling.
Mm-hmm.
And so I sold 3/4 of my portfolio, about almost 3,000 units in 2021 and the first half of 2022. I could have refied them,
Mm-hmm.
pulled out cash, returned cash, and held them. But, I saw, a crash coming in the market and decided that probably better to sell at the peak and not lever up and take on more risk in the face of that uncertainty. So started selling and never got a chance to refinance any of those properties. But boy, selling turned out to be a great idea.
Oh yeah. So what markets were you kind of like, did you have exposure and footprints in?
Mostly southeastern US, Texas,
Okay.
Arizona, Georgia, Florida.
Okay. Yeah. So was it hard? I mean, I know you had some experience with selling, not just with those two properties that you 1031 into your first larger property, but is selling hard for you? Because it certainly is for me. I get like an emotional attachment to my properties because I know everything that went into getting that deal. And it's almost like if I sell it, then it's the last time that property paid me. So how do you get over that?
I have no emotional attachment. I really don't care. It's really like my emotional attachment comes from the fact that we want to take care of our residents. I care about our staff and the staff that's at those properties. But that real estate itself is really just an asset that backs financial performance. And if we're out to maximize financial performance, we have to detach the real estate from an emotional standpoint from that investment performance as a practical matter. So that's just what we do. We buy and we improve and we sell. And it's easy to get over the emotional attachment when you can deliver a high double-digit return to your investors and put checks into your own account that have 2 commas in it. You get over that emotion really quickly.
Nice. So let's shift gears a little bit and talk about capital raising, because that's another big bottleneck with investors' growth, that and deal flow, right? So tell us about kind of like how you started, raising capital in a big way, and kind of, what, your beginning moments of that as a syndicator.
Well, I started raising capital fairly early on in my career because I had no option. when I started in this business, I had no money. I had no knowledge. I had no contacts. I had no friends in the industry. I mean, I had nothing, literally nothing. So, when I did my first deal, of course, I did it with no money down. And my second deal, I maxed out a stack of credit cards to get that deal. And then I started getting like signature lines of credit and maxing those out. And finally, my own house had gone up in value a little bit, and I was able to get an equity line and combine the equity line with the credit cards and the signature line of credit. But that's not scalable. So at a certain point, I got to get outside capital. So this actually happened when I quit my W-2. I told everybody at the police station where I was leaving, and I said, hey, I put in my 2 weeks notice, but I'm giving a presentation. I rented out the room at the community center next week. Everybody come and I'll tell you what I'm doing and why I'm quitting. And so, of course, everybody came. And so I gave on this little presentation about what I was doing in real estate and this and that and the other thing. And I'm like, look, if you guys will give me money, I will split the profits of the deals with you guys 50-50. I'll take investments as small as $5,000. And I'll be damned if I didn't walk out of that meeting with $500,000 in investment commitments. But now, I've got 28 investors that carry guns. So, so now I also know, like, okay, I've got investor money. I can do more deals. I have full discretionary control over the capital. But if I lose this money, I'm a dead man. Mm-hmm. So preservation of capital became like my driving mantra. Like, there's no way, no how, whatever happens, I just can't lose people's money. And thank God, 22 years later, I haven't lost a nickel of people's capital. And I'm trying to keep that going. So that was like my first foray into raising money. And I used that. I created actually a blind pool fund. I had full discretionary control of the capital. I could buy that to buy all the flips I wanted. And I was doing about, a couple dozen houses a year, house flips with that money. And, of course, as time goes by, and now I had bought my apartment building and, done a few commercial deals and this and that. And I thought, I want to buy bigger apartment buildings, and I'm going to need investor money to do it. And there were always people calling me because, they heard from this guy or that guy, oh, they've invested with me and that they've been getting a good return. And, do you have anything for me? And it just kind of so happened, like I had this deal, it's a 60 unit apartment building. And right when I was looking at it, all these people were calling me wanting to give me money. And it's like, as a matter of fact, I do have a deal, so I put the money into that, did that deal, and then just rinse and repeat. And I was doing it over and over and over and over and over again. And, and I started out with 28 investors, and now I have over 2,800. And, started out with $500,000 fund, and now I've probably we're coming close to 300 million. And, it all just starts by putting one foot in front of the other.
Absolutely. That's an awesome story. Now, so if you were to give advice to, let's say, a regular investor that maybe owns a handful of units, is always, pulled from their own capital, whether it was credit cards, because we got a lot of scrappy people that are in our sphere of influence. Like, what advice would you give them to kind of like, to get started, some tactical things in getting started on, the concept of raising capital and talking to potential investment partners?
Well, it really comes down to getting those potential investment partners to trust you and your investment plan and your asset that you're investing in. So I would say this is a really good time right now. Actually, this is a horrible time to be buying anything. I mean, I haven't bought any multifamily properties in about a year and a half, and probably won't for another at least half a year, maybe a year, who knows. But this is a great time to be building your business and preparing for what comes next in the markets. And so take this time now to document your track record, give some kind of an exhibit that you can show people that says, look, here's what I've done. Here's the 2 houses I flipped, and here's before and after pictures. Here's how much we made off of it. Here's the rental property I bought, and this is what the rent was when I bought it, and this is what the rent is now, and this is what I did to fix it up, and or this is what I sold it for, or whatever it is that you've done. Put something together that you can show to people so they can see what you've done and document your track record. The next thing is to go build that audience. and figure out who you're going to go talk to show this thing to, right? If you have nobody to talk to, then all that work isn't going to do you any good. So get yourself out there and meet people, go to conferences, REIA meetings, whatever it is, use social media, online, whatever it is. Build your audience, and that's really the stage you need to be in right now. Who you're going to talk to and what you're going to say to them, get all that stuff sorted out.
100%. So one of the things I tell my students is it's easier to ask for money when you don't need it. Same goes for investors and banks. Do you agree with that?
Well, yeah, to a point. I mean, you also need to have a place for it, right? You're ultimately going to have a something to invest that money, and they're not going to just give it to you and go, "Hey, thanks, I'll call you in a few years when I find a deal." So it's kind of difficult because people ask all the time, like, what comes first, the deal or the money? And the answer is always the money. Mm-hmm. I don't care if you're going to go to the grocery store and buy groceries. You never ask the question, like, do I get the groceries first or do I get a paycheck first to go buy the groceries? That's never a question. I mean, you always have to, you walk into the store with money ready to go, right? And it's the same thing in investing in real estate. You gotta line up your investors. And that's why the best time to ask for it is, or even if you're not even asking for it, you're building their trust so that when you do ask, they're ready to go. The best time to do that is when you don't need it. Because if you need it and you've got a deal about to close and now you're going to go out and start talking to people, way too late. You're not going to build the kind of trust you need to build to get them to invest thousands or hundreds of thousands of dollars with you inside of a 30-day escrow clock.
Absolutely. So what do you like? What's kind of like how do you pop the question to a potential investment partner that you don't quite have like, let's say one of your funds is closed, or you're just not, raising capital at this point in time, but you want that person to think of you in that way. Like, how do you kind of pop that question?
Well, there's not really a question to ask at this point, right? Because you've got nothing for them. So the best thing to do is always to say, look, I'm going to show you examples of everything we've done. I'll tell you about the last fund that we raised or the last deal that we did. And if it sounds interesting to you, the next thing we do will probably look a lot like that. Mm-hmm. So if you can show them kind of the way, then you'll at least have educated them to the point where the next time you go to talk to them about your actual deal, all that stuff is out of the way. They've learned who you are. They've learned what you know. They've learned about your track record. They've seen the kind of deals you do. Now all they have to do is just update that to the latest one. And that takes a lot less time than starting from scratch. The trick here too is like, well, what if a long period of time goes between those two events? By the time I talk to them to the time I have a deal, they're going to forget about me. Well, that's up to you to make sure you're staying in touch with them and updating them on what's going on, and have a newsletter or an email that goes out, or social media presence, and they follow you, and you can put out posts about what you're doing or what you're thinking or what your thoughts are on the market, what you're seeing, news events. Oh, hey, I just heard about this multifamily property that went into foreclosure. That's interesting. What's happening in the market? This is what I think about it. Be that kind of thought leader for those people so that they'll not forget all that great information you gave them in those early meetings.
That is like golden advice. And so we're actually going to go into our live Q&A. Are you ready?
I don't know. Should I be?
Yeah. So for those of you listening on the recorded podcast, this is the Go Big Live podcast for a reason. We have a interview that's for the first half an hour, and then we open up for live Q&A in our Facebook group. So definitely be sure to check out the Go Big Live Real Estate Investors group. Request to join in, and I'll let you in. And that way you can direct your questions directly to rock stars like Brian Burke. So for now, for you listening out in podcast land, we're signing out. My name is Matt Druin, and thank you so much for having us up, Brian.
Thanks for having me here.